Hello and welcome. Today, we're going to try and get inside the mind of one of the world's greatest investors. We're going to break down Warren Buffett's own words to really understand his core philosophy on how to figure out what a company is truly worth.
So, here's our roadmap. We'll kick things off with the single most important concept, which is intrinsic value. Then we'll look at why a really common metric, book value, can actually fool you. After that, we'll dig into a weird quirk in accounting, explore the difference between a stock's price and its real value, and then we'll wrap it all up by looking at how this applies to Berkshire Hathaway itself.
All right, let's start with the big one. This is the idea that Buffett says is the absolute foundation for everything else in investing.
And that quote says it all. For Buffett, figuring out intrinsic value isn't just one strategy among many. He says it is the only logical way to think about investing. Everything else is just a distraction that can get you into trouble.
So what is it exactly? Well, the definition sounds pretty simple. You just have to ask, if I owned this whole company from today until the day it shuts down, how much actual cash could I take out of it? That's it. That number, with a little adjustment, because money in the future is worth less than money today, is its intrinsic value.
But here's where it gets tricky. See, intrinsic value isn't a hard number you can find in a report. It's an estimate, and it's always changing. If interest rates move or your forecast for the business changes, your estimate has to change too. In fact, even Buffett and his partner Charlie Munger will look at the exact same business and come up with two different numbers. It really is more of an art than a pure science.
Okay, so if intrinsic value is this kind of fuzzy estimate, what about a number that isn't fuzzy? Let's talk about book value, and more importantly, why leaning on it can be a really big mistake.
And this example from Berkshire's own history just shows you the problem perfectly. Back in 1964, the book value was almost $20 a share, but the company was a dying textile mill. Those assets weren't really worth what the accounting books said. Now fast forward to 1996, the book value was over $15,000, but the real intrinsic value was way, way higher, because book value didn't come close to capturing the incredible earning power of the companies Berkshire then owned.
You know, this whole idea can feel a little bit abstract. So let's use an analogy to make this difference between cost and value feel a lot more real.
Just think about a college education. The book value is what you paid for it, right? Tuition, books, plus all the salary you didn't earn while you were in school. But the intrinsic value, that's all the extra money you'll hopefully earn over your entire career because you went to college. The point is, the price you paid tells you almost nothing about the ultimate value you get.
Okay, so we've established that what something costs isn't the same as what it's worth. Now let's look at a strange little puzzle in the world of accounting that makes seeing a company's true value even harder.
Buffett actually uses the word schizophrenic to describe what happens with standard accounting. And that's because the rules force a company to present its financial reality in two totally different and often contradictory ways at the exact same time.
So here's the puzzle. When Berkshire owns a company completely, it gets to report all of that company's earnings. But on the balance sheet, the value of that company is stuck at whatever Berkshire paid for it years ago. Now, for the stocks Berkshire owns just a piece of, it's the total opposite. Only the tiny dividends they receive show up as earnings, but the value of the asset gets updated to the current market price every day. It's a total mismatch.
So what are you supposed to do with this mess? Well, you have to learn to look past these weird accounting rules. The goal is to piece together the real underlying earning power of all the different businesses a company owns, whether it's the whole thing or just a small piece.
All right, let's talk about the number we all see flashing on our screens every second of the day, the stock price. How does that relate to this deeper, more complicated idea of intrinsic value?
For a long time, Berkshire's stock price pretty consistently traded for a little bit less than what its intrinsic value is estimated to be. But that's not a rule. Sometimes the market gets really excited, and the price can shoot way above the actual value. You have to remember, the market isn't always rational.
This quote is the punchline to a story Buffett tells. An oil prospector gets to heaven and is a little lonely, so he starts a rumor that they've struck oil down in hell. Sure enough, all the other oil men stampede out of heaven to go check it out. He watches them go, and then he thinks to himself, you know what, maybe I should go too. There might be some truth to that rumor. It's a perfect illustration of how powerful that herd mentality can be.
So what's the job of a good management team in all this? It's actually to try and keep that gap between price and value as small as possible. By being transparent and communicating clearly, they try to make sure the stock price is a fair reflection of reality. That way, when one person sells their share to someone else, it's a fair deal for both of them.
Okay, to bring this all together, let's look at the two key pieces of data Buffett himself shares to help people start thinking about Berkshire's own intrinsic value.
First up, we have the per-share value of Berkshire's investments, which is mostly its stock portfolio. And you can see that incredible long-term growth of 28% a year. But notice the last decade here. From 95 to 2005, that growth slowed down pretty significantly to 13%.
Now, let's look at the second piece of the puzzle. The earnings from the businesses Berkshire owns outright. The long-term growth is still a very healthy 17%. But look what happened between 1995 and 2005. The growth rate actually sped up a lot, to over 30% a year.
This chart just makes that reversal crystal clear, doesn't it? The growth from their stock holdings was slowing down, while the growth from owning entire businesses was taking off like a rocket. And this shows you a huge shift in Berkshire's strategy, focusing more on buying whole companies.
Buffett uses this little joke to explain their situation. He's saying that like the old husband, it's getting harder and harder for a company as big as Berkshire to do everything at once. But he and Charlie are still trying to increase both of these metrics, investments and earnings. They don't want to have to choose.
And really, that leaves us with a big challenge at the heart of this entire philosophy. The numbers you see in a financial statement are just the starting point. The real work, the art of it all, is learning how to look past those numbers and see the true, durable, long-term earning power of a business. And that right there is the secret to value investing.